In the last 2 weeks, we have all been bombarded with words like GameStop, Reddit, short squeeze, kill the hedge funds, diamond hands, and to the moon. We have seen the emojis splashed around our screens. People have been watching GameStop rather than S&P 500. Nobody noticed there was an FOMC meeting. The trading and investment has suddenly become personal. There is so much emotion, so much anger. It's all about killing the hedge funds, sticking it up to the big guys. Occupy Wall Street, version 2.0. Let's try to figure out what all is going on. Welcome, everyone. I am Vaibhav Shukla. I am one of the partners at the MoneyWiseSmart, and I look after their option series. We at MoneyWiseSmart are not silent spectators when opportunities present itself. We are slow and steady, but we look at the opportunities as and when they present, and we apply our principles in capitalizing those opportunities. Most importantly, we try to remain calm and sane. We always ask ourselves, what if I'm wrong? We cover the downside, we open the upside. We may not be the rocket to the moon, but we also don't burn out so easily. Welcome to this short update on how we look at this situation and answer some of the questions which you might have. We will also show you how we looked at this opportunity presented, and you'll be surprised to learn what we did. Unless you are our subscriber, then you would know how we think. If you're not our subscriber, we welcome you to our course. So please find the details in the descriptions. Before we start, please hit the like button so that the YouTube algorithms can help us promote this video to people like you. We sincerely appreciate your support in this regard. If you would like to receive more information and further updates on these developing opportunities, please hit the subscribe button. Thank you. Before I proceed, our standard disclaimer. The discussions in these videos and our courses are only for educational purposes. We are not financial advisors, and if you are here for any investment advice, you must stop now. You are at the wrong place. None of what I'm going to say in this video is taken for the purpose of investment decision. Please consider these materials purely for the educational purposes and your own learning. Before making any decisions, do your own due diligence. So there has been so much talk about short squeeze. So let us understand what is short squeeze, what is short, what is long. Imagine in a stock market, you have somebody called Jen. Jen is an investor. She likes a particular share, which is trading at $10 per share. She has done her research. She believes the share price is going to go up. The company has good fortunes. The company is compounding. She's a long-term investor. And she has cash to buy the shares. So what does she do? She places an order to buy. And her order is filled. Jen pays $1,000 and she gets her 100 shares. She is long. Now when she is long, she will participate in all the future dividends of the company. She will, if the share price rises, her investment value will go up. If the share price is 15, her portfolio will be worth 1,500. If the share price is 20, her investment will be valued at 2,000. She doesn't need to do anything after this point. And if she does not need the money immediately, or she is not on the margin, if she has paid for her shares, effectively she can sit tight. She can sit on the share indefinitely and benefit from any future upside on the shares. Even if the company goes bankrupt, if the shares become zero, all she will lose is her investment. And of course, the opportunity cost, which we value a lot in MoneyWiseSmart. On the other end, here is Jen sitting with 100 shares. On the other hand, you have Melvin. Melvin believes share price is too high. Melvin does not like the company's prospect. He thinks the price is too overpriced, and he wants to bet on the decline of the share price. So Melvin wants to sell the shares which he does not own. What does he do? He borrows the share from Jen and sells it out. And he gets $2,000 from the buyer, and he is effectively short. If the price of the shares drop later on, Melvin will buy back the shares at lower price, and he will have to spend a smaller amount, and the difference will be his profit. However, Melvin cannot sit tight like Jen. He has to pay interest on the share he borrowed. This is called the borrow fees. If Jen wants the shares back, she can call them anytime, and Melvin will have to secure somebody else to borrow from. Effectively, Melvin is sitting on a ticking clock. He's losing money every day while he's short. In addition, if the company ends up announcing better results, or suddenly somebody buys the company for very high valuation, there is no limit to the loss Melvin will suffer. How the price can go at any level. Melvin's loss is unlimited. It's really risky to be in a short position. So how can the short interest be higher than the float of the company? How can you sell more shares than they are outstanding in the market? Well, as you can see in the previous slide, you can borrow the share and sell, and you can keep repeating it forever and ever. Melvin can borrow from Jen to sell to Julia. Now, Jen owns 100 shares, Julia owns 100 shares, and Melvin is short 100. As you can see, 100 shares are suddenly owned by two people because Melvin is in between, and Melvin has got his $2,000. When there is a demand in the market maker can keep borrowing from the longs and keep selling to the buyers. If Joanne enters the market and she's interested in buy 100 shares, Melvin can now borrow from Julia and sell it to Joanne. Now you can see there are 300 shares or 300 long shares and 200 short, and Melvin is sitting with $4,000. In simple terms, this is all about the demand and supply between the buyers and sellers. The long and short ensures that the market is balanced. When there is a demand, you can fulfill the demand by borrowing the shares and selling it to the buyers. And when people are looking to sell, the short sellers can cover and make sure that the borrowed shares are returned. It is not always evil to be a short seller. In fact, it's an essential part of market making, which is what keeps the bid offer very tight in our markets. If there were no short sellers, the bid offers would be wider. It will not be easier to buy and sell shares easily. The lenders of the shares receive the borrow fee, and it's part of their income. Most brokerages, when they are giving you zero commission, they are not doing it because they love you. They earn their money from your order flow, or they earn their money from the stock borrowing fees. As you can see, with just 100 shares in the market, you can sell it to 3 people. The more the number of borrowing, the more the borrowing fees the short sellers will earn. Short sellers are the ones who are taking all the risk in the market. If the price goes up, their losses are unlimited. When the price is rising, the short sellers are squeezed. But the dynamics are usually balanced. It's not just the short sellers who are taking the risk. The long are also taking the risk. If the prices are dropping, they are suffering the loss from their side. This will ensure an effective and functioning market. These are various forces in play in the markets. And now if you throw in the options market, the stock issuing, stock borrowing, and other factors, there are the several factors which ultimately make the market. The market is essentially created by several participants. This has been explained in several posts on our Facebook groups, and I welcome you to join and subscribe those groups. If you are our subscribers, you can join our premium group as well. The link is provided below. For the subscriber, we discuss these topics in details. We also do our monthly tutorials. And if you do join our courses, then we go into a very detailed way of using options for generating cash flow and long-term investment. So what happened to this GameStop? Well, GameStop, as you would know by now, is a troubled retailer. They sell games consoles. It's like selling DVDs in the world of Netflix. Nowadays, nobody buys DVDs, or the DVD player, for example. They are a brick and mortar retailer. They have stores in various malls in America. It's been popular with the people. Some people are very passionate about, they go there for nostalgia, the antique values, and so on. There are strong supporters of GameStop. But it has been in trouble. If you look at their financials, their revenues have been declining over the period. They are coming under pressure because of the cost of the stores. And you would realize the business has been under tremendous pressure for quite some time. It's not a new phenomenon. Why is that the case? Because more and more gamers now prefer to use the games online. They buy the consoles on Amazon, if at all. They download the games on the console, and before they start playing, they are being squeezed from the online retailers and the online delivery of the games. The mall-based business is under severe attack from the e-commerce industry. And then COVID happened. When everything was shut down, the GameStop was under tremendous pressure. Nobody was going in the malls to buy their games and consoles. So based on this diminishing prospect, some hedge funds have started taking aggressive positions, and they were sniffing around for short selling. They were very public about their research. They have been talking in the press about them, and they were promoting their short research in the hope of winning their trade. But there are always two sides of the coin. So there were some activist investors who were building up stake in GameStop. They were looking at it as a turnaround story. They thought they can convert it into a business which can adopt e-commerce and build on the brand and the loyal following it had. And they have a good idea in that aspect. So meanwhile, nobody knows why, but a group of Redditors on a Wall Street Bet subreddit started building aggressive positions in GameStop. They started aggressively buying the out-of-money options. They even took the stock positions. They started creating memes. They made it a fun. They made it a crowd source, and everybody eventually jumped into the stock. And when so many people come in, there was a massive short squeeze. As you can see in this chart, what was somewhere around $17 that suddenly shot up to $325. In fact, it shot up to $480, and in the after-hour sessions, sometimes even to $500 level as well. It's a massive, massive jump. So almost 1,700% gain. It's like 17 times in a span of just 1 month. Two hedge funds, Citron Research and Melvin, publicly acknowledged losses on their short positions. Many online brokerage firms came almost to the brink of liquidity crisis, possibly bankruptcy. They had to draw on additional funds from their prime brokers to allow or continue trading. They started putting restrictions. There was big news of Robinhood restricting the accounts from buying GameStop. Pretty much every broker increased the margins on the positions. Now to buy a GameStop, you have to put 100% margin. When you want to sell short position, you have to put almost 300% margin. And even after that, many brokers started putting restrictions on options trade. So that's happened. Now everybody is itching to know what to do. Shall we buy? Shall we sell? Shall we buy calls? Shall we short calls? Shall we buy puts? Are we going the rocket to the moon, or this is going to crash and burn? There's so much FOMO, fear of missing out. There is so much passion of YOLO, you live only once. There are so many options. You can buy the stock, you can sell the stock. Everybody is going a bit crazy. There's so much emotion. Many people are just doing it out of anger against the hedge funds or Wall Street, or maybe some unknown villain in this whole picture. There is anger against the system, as if the government is against them, the brokers are against them, the whole world is against them. Some people are sitting on very, very lucrative profit. There is no doubt this has been a life-changing event for many of the investors. Some have even cashed out good profit. I hope they cashed out. I only wish and pray that they keep their profit safe and invest it wisely, keep compounding. But we would never know, is it going to go up or is it going to go down? We can't speculate on the short-term movements in MoneyWiseSmart. We cannot predict the future. But what we always do at MoneyWiseSmart is to sit back calmly and look at the facts and the information available to us. We act on the available facts, and this is exactly what we did. We looked at the business balance sheet. We looked at their regulatory filings. We looked at what could be the potential value of the business. Is it going to go bankrupt? It was, when this whole drama started, there was a big risk of bankruptcy. Or is it going to go to 1,000 or 5,000 or to the moon? Nobody knows. We are not speculators. We like to go deep into the company, and we look at it from a calm and calculated mind. So we jumped straight into the company's financial reports, which I suggest everybody should read, not just look at the price chart. The price chart actually is pretty meaningless for us. So we looked at that, and we discussed it in one of our recent tutorial, subscriber-only tutorial. And my partner, Fan Liang, had done research on the company, very quick research. We did not get time to do a deep dive, but we did a quick research, and I would like you to have a look at what he had to say on the company and its financial.
So let's take a quick jump into the business first. Just a very quick look before we do anything. We always want to understand at least the business a bit first. Let me share my screen, if that's okay. Hello?
Yeah. So you are already host, right?
Yep. So while you guys are waiting for the screen to come up, can you see my screen?
Yep. Yes, we can see your screen.
With a GameStop press release?
Yes.
Cool. So just now, from the poll, we know that probably, I think 14 people has done something on GameStop. So just a quick question first. Have anyone actually read their latest press release, which is for the 2020 Q3 results?
You can
I
type.
can't see the.
You can
chat,
type on the
sorry.
chat and let us know.
Yeah.
Oh yeah, I can see.
No or yes.
Nope. Nope. And has anyone read it? One? Nope. Okay, cool. Let's take a quick look now. So this is what we did when we were thinking whether to, is there any opportunity in GameStop? We went to the IR website, downloaded their latest release just to get a sense of what their numbers look like. What's our downside? That's the first question you want to ask. Whether is there any value in balance sheet? So for those who don't know, GameStop sells video games, video titles, video consoles, and they've been mainly selling it in their brick and mortar stores. So even though game industry is booming, but their business was actually dying, and there were concerns whether they will go bankrupt. And then, of course, now they are slowly transitioning to selling digital too, but there were a lot of concerns, they were making losses. So let's take a quick look just at the Q3 results here. So you can see the results. It has gone up. They've done some initiatives to go into more into e-commerce, and they released some long-awaited video game consoles, blah, blah, blah. And then let's just go straight to their financials. And then they undertook some restructuring. They closed down their retail and mortar store too, to gradually shift towards online. So let's go to the income statement. So this is GameStop's income statement in USD million. And this is for the quarter ending October. So 2020 Q3 for them. You can see here, they made about 1 billion sales, low gross profit margin, about 300 million gross profit. And then at the bottom here, we see that they actually make a loss in that quarter of about 20 million. So just remember that they lost 20 million in that quarter itself. And then if we go down to the next page to see how does it look for the overall 2020 first 9 months, which is shown here, you can see they actually lost 300 million in the first 9 months. So this is a business that was losing a lot of money, but they lost 300 million in first 9 months, but they actually only lost 20 million or so in the last 3 months. So they were actually slowly improving. And then the CEO also mentioned that they were expecting them to be slightly profitable in Q4 and then going onwards, due to how they've restructured their business by cutting down the loss-making businesses, closing down stores and shifting towards online. So the bottom line is they probably would be making some losses now, but they might break even soon. And then next, let's see whether there's some value in their balance sheet. So as of October 31st, we can see here on their asset side, there's some cash. So about 600 million of cash plus restricted cash. And then there's a lot of inventory of about 860 million. Whether that's worth something, it might not be worth 100%, but getting to a precise number is not needed for our thesis in GameStop here. And then let's look at the liability side. What do they owe people? Let's look at their debt first. We can see they have short-term debt of about 240 million, and then long-term debt of 216, and then another revolving credit of 25. So this sums up to about, say, 500 million. And just now we saw that they have about 600 million cash. So we can say they sort of offset each other. We just reserve some in case they need some more working capital. And then on top of the normal debt, one thing to take note is, like Waiwat mentioned, they have actually a huge portion of operating lease. So 200 million current and another 450 non-current. So let's call it, round it up, say that's another 700 million. So they could be owing someone 700 million and don't have the money to pay them. So that should be a concern. And if we come back up to their net working capital, in terms of receivables, inventories, they're about 860 inventory, but on their payable and accrued liabilities, they owe current portion of them of about 1.1 billion. So these sorts of offset each other, but they are still short about 200-300 million. So in the short term, if everyone start asking them to pay, they could potentially go bankrupt. So at this point, does anyone think that they'll go bankrupt? Is this a concern to us? Like, can we sell a put on them? Is it risky? Any comments from the floor?
And you have to type in the chat. That question is, do you think GameStop can go bankrupt looking at this balance sheet?
Yep.
Yep. So there.
I think so. Yep. Nope. High risk. Yep. Issue more shares.
Priscilla is
Priscilla,
on the money.
Yeah. Priscilla, would you like to elaborate more on that a bit? Like, did you see anything about them saying they want to release shares, or it's just a guess?
Priscilla speaking.
Maybe you read somewhere. Yeah, I think, have you read maybe you have read this financial report. So just now I've not done the justice. I've just scrolled straight towards the financial statements. So now let's look back out a bit to look at the final details. So first page, there's nothing much interesting. Second page, there's nothing much interesting. But when we come to this portion here, they were talking about their liquidity. How much cash do they have? About 600 million. How much debt do they have? And then they were trying to redeem some of their senior notes early to reduce their debt. And then let's look at this paragraph here, in particular, the yellow highlighted text. The company was saying in December, this press release was released in December. The company was saying that as part of its strategies to create optimal financial flexibility and to expand liquidity alternatives, the company intends to file a shelf registration and prospectus, which it may offer and sell from time to time more of its common A, Class A shares in at the market offerings. So let me just explain a bit, what does this at the market offering mean? When a company wants to raise money, it can raise through debt or equity, and equity meaning stocks as one of the equity format. And if a company wants to issue more shares, there are various routes to do it. The first one that most people will be aware of is you can go IPO, initial public offering. That's when the company first lists itself. And then later on, if you still want to get more money, most companies actually do a secondary offering. They can list more shares. They have to run their sales shows again, hire underwriter, hire big banks to do it. But that's not the at the market offering. At the market offering are actually used by companies when they're expecting that they might need some liquidity in the future, and then they don't want to go through all the trouble to do a very proper offering. So they can actually go to their broker or dealers, they can get a few people in and then say, I might want to issue another 1 million shares in the next 3 months. Can you help me to do it? And then the dealer will say, yeah, of course, I'll charge you 1 to 3%. And then what the broker and dealer will then go to do is whenever they see opportunities, maybe the company will say, I only want to issue above $100 per share. The broker will actually look at the market. Whenever they see their opportunity to actually sell a lot of shares in the market, they'll just sell the shares and then later on issue the shares. And so this is what GameStop says in December, that they intend to do so. Look at this, they say they intend, but they actually didn't say they've confirmed that they are doing it. So in this case, how many of you have changed your mind that, or this company might not go bankrupt? Or are you guys still sticking with the thoughts that it's still a high risk opportunity?
Like, think yourself like the owner of this company or the CEO of the company, and your stock is already sitting at 500. What would you do?
So Paul is saying possible to go bankrupt unless they have a viable turnaround plan. Paul, let me encourage you to think. Let's step back from GME and think about a very simple example. Let's say that I I'm feeling very hungry and I I don't have any money, so I borrowed $10 from you, or let's say I just have $5 in my pocket. I go and borrow $5 from you, and I buy a $10 pizza. Now it turns out to be a really bad pizza. It's not great, and uh, however, whether I like it or not, I have to repay you the $5, and I can't. I don't feel like eating it, but suddenly, for some bizarre reason, there seems to be a huge market demand for this pizza. So I'm able to cut out a small slice of this pizza, and let's say I'm able to go and sell that slice for $500. So now the pizza becomes irrelevant. The fact that by selling that small slice, I'm able to bring in $500, I completely remove any possibility of me going bankrupt, because not only I can repay you your $5, I will still have a lot of cash, that I have managed to bring in. I say, so in GameStop's situation, while we are not convinced about their business, can there be a turnaround? Of course, there can be a turnaround. They seem to be talking about their digital, transformation and all those things. Of course, there can be a turnaround.
They got
They
a new
seem
board
the
member
right,
as well.
yeah, they seem to be taking the right steps, but thanks to this share price rocketing up right now, their share price has somehow, in a very distorted way, become their biggest asset. And and their board actually has a fiduciary duty to go and do this at the money offering, sorry, at the market offering. And if they do that, they will be able to, just because of their share price, they will be able to bring in enough cash to take care of all their liabilities. And it really doesn't matter at this point of time whether they will be able to turn around or not. I mean, they can just issue the shares and remove that black cloud. So that is the situation. Sorry, Fan Liang, go ahead.
Yep, so I see some comments. So let me just elaborate more a bit on this at the market offering. So what we can see from this press release is only the company is saying that I intend to do so. Have they actually done so? No one knows. So what we as investors need to know is we want more assurity, whether are they just talking empty or have they actually done something. So let me just probably answer some of the question on at the market offering to explain how this works first. So to answer Pauline's question, yes, to do a at the market offering, right now, the company has about 69 million shares. If they want to do this offering, they would have to issue new shares. Maybe they will say, I'm willing to issue another 2 million shares, another 5 million shares, another 10 million shares. This one we won't know until we get the next quarterly results, when they are actually obliged to announce any new shares that they have issued. So with that, I hope that's clear on how this works. And then Max have some question, which is very valid, whether like, have they done so? Do we know? Do they need to lodge a prospectus? The answer is yes. So for a company to issue at the market offering, it needs to lodge with the SEC, the Securities Exchange, a form called S3. And that's what we have done to see whether have they actually just talked empty or have they actually done something. So if you go to the SEC, you can see that they have indeed filed this form called Form S3. And then it's a 29-page document, but the key point here is, see here, it basically says that we may offer and sell from time to time any of the securities listed above in this prospectus, which means since they've done this now, from any time from now onwards, they can instruct their dealers to issue common shares, preferred stock, depository shares, warrants, or subscription right, blah, blah, blah. This means at least the company has done something. Now, whether they've actually issued, like we said, we won't know. We have tried our luck. We send the IR an email, but we know that in this saga, they won't even have time to reply to us. And they might not be legally allowed to do so too, but we're just trying our luck. So our thesis is that, as Waiwap and Ruban mentioned, if you are sitting on the board of this company, you see this opportunity, you might go bankrupt soon if you don't turn around your business. And then suddenly, for whatever reason, this market, Mr. Market, went crazy and is willing to buy my pizza away for $500 when it's like a $5 pizza. Like, as a board member, whether does the board has fiduciary duty not to issue shares and let this company go bankrupt? The future is always uncertain, and we won't say they definitely won't go bankrupt, but the chance that we put on this scenario will be quite little, just due to how these circumstances has turned out, that share price has shot up. They have this at the market offering in place, and even without this, they can still do private placement and other kind of transactions to raise money.
Yeah, I mean, if you look in the same SEC note, they make it very clear. Their charter allows them to issue 300 million shares without any permission from shareholders, which means the board of directors actually have a blank check for up to 300 million shares and up to some 5 million preferred shares and so on. Yeah, that's the clause. And they only have 69 issued so far. So, I mean, of course, things can go crazy, but all this chatter which is going on that there is impossible to cover shares, impossible to cover shorts and so on. Just imagine if I'm really, really screwed and I'm very big. I mean, there are a lot of conspiracy theories going around in the internet. So let me give you one more conspiracy theory, that if I'm stuck on their short and I'm friends with SEC and the prospectus is already filed, SEC can make a call to their board and say, guys, if you don't issue new shares, I'm going to start an investigation. That can happen. And these things can happen. Like, any rational board would use this opportunity eventually to collect some cash because they desperately need the cash. I mean, 2 months ago, they were in a desperate need of cash. All their activist investors will be also demanding that the company capitalize on this situation. And who knows when the next filing comes, because it won't be announced on a day-by-day basis, but in the next filing, you might end up finding that they did issue, let's say, 10 million shares, let's say at a price of 100, assuming they issued it at a very low price. But even that gives them almost $1 billion in cash. So that $1 billion takes away all their liabilities, their lease liabilities, they can pay off their bonds, their inventory becomes free. So after that, and just do the other calculation. Let's say if they issue 10 million shares, the total number of shares will become, for argument's sake, 80 million, 11 million shares if they issue. 80 million shares, and you are sitting on a cash of almost 1.6 billion. That's how much? $2 per cash, roughly. So
$20, $2, yeah.
$20.
Today, if they issue 11 million shares, even if we assume that they are doing it at, let's say, right now the share price is 450. Even if we assume that they are issuing it on an average price of, let's say, $200, we are still talking of 2.2 billion, I mean, over $2 billion. So they can completely wipe out all their liabilities.
And $2 billion, after they issue 10 million shares, they would have about 80 million shares. So 2 billion divided by 80 million shares, they have about $25 per share. Yeah. And the put that Waiwap showed everyone just now, we were selling puts of $2 at $2 strike.
So based on this, the way, again, we started thinking it like a Jumia kind of situation here, that they potentially can be sitting on at least $10 per share cash value, at least. I mean, if they act smartly, and you have to assume that they will act smartly, because it's like kind of a lifetime opportunity that my company was struggling and suddenly the shares are at 500. I will sell some more shares. I mean, Tesla did that in the end. Even Tesla raised 5 billion when the share price was shooting up. So that's how these shelf registration happens, and that's how possibly the short squeeze can be killed as well eventually. And when that happens, and we, let's say, found a floor of 10, but again, we were not sure because the game is a very crazy company. So we picked the lowest strike possible. So the lowest strike possible and the longest strike possible we found was $2. Thank you, Fanya. So what did we see? We saw the implied volatilities are really, really high. They are unbelievably high. You would expect them if there is such a big short squeeze going on. The volatilities are the first thing which go up drastically. We also found that somehow the risk of bankruptcy are reducing. The bond markets, the bonds of GameStop are not trading at a distress level. They are trading more or less at a reasonable level. There is no panic in the bond market that the GameStop is going bankrupt. And why would it? This is almost knocking into S&P 500 with their current market capitalization. The only problem is they don't make profit. Otherwise, people would be talking about their entry in S&P 500. There is a big talk of turnaround. There are some new investors. There is a new members in the board. The people are experienced turning around the people, converting them into online businesses, the new way of selling to the masses. There is a great opportunity for the management to raise additional cash. Like, just imagine if you are the CEO of GameStop or the board and you are seeing your share trading almost at 300. You have already filed with SEC to do a shelf offering. Shelf offering means the company can sell shares to public or to institutions in the open market. And the shares are now trading at such a big level that you can practically pay off all your debt. You can pay off all your store liabilities. You can refinance all your inventory. It's such a tremendous opportunity for the management. But we also found that the current levels are detached from the reality. I'm sorry to say, I mean, we don't believe the shares are worth 300. We don't believe they are going to 1,000 at such levels right now. They can in future, nobody knows, but the current value does not appear to be the level at which it's trading. And that's been our overall finding on GameStop so far. So with that available information, the walls are too high, share price is too expensive, calls are not worth buying, too expensive, but the company is not going bankrupt. What do? We feel that the management has an opportunity to take advantage of this elevated price because they are the one who can issue the shares in the market. And if they do it wisely, they can potentially bring almost $6 to $7 per share for the company. They can build a big cushion. They can put a floor under the price. And we believe they might do it, but we have written to their investor relation, and they have not responded to us. I don't think they will respond to us just alone. They might want to make it public in their filing. So what do we do with this available information? We know the walls are high, and we know and we feel the odds of bankruptcy have been removed a lot to a great extent. The company in near future is not going bankrupt, we feel. So we went for the lowest available strike on the put option, and we went for the longest available expiry, which is the January 20th, 2023, almost 2 years ahead of us. And we looked at the contract, how it is trading. It's a Monday. You might be surprised why I put a turtle, because turtle lives for almost 200 years, even though it's slow, but it keeps going. So slow and steady. So look at the prices here. It's a $2 put, and it's almost trading at 50 cents. The implied vol is 164, which is pretty high for something expiring in 2 years' time. It's trading reasonably, and there is a reasonable open interest as well. So with such elevated IV, and it can go higher, we predicted it will go higher the way markets are trading. If we sell this put, and we secure the put by cash, which is how we do it MoneyWiseSmart. If we sell it at 50, we will receive a premium of $2,500 on a $10,000 notional. Like if we sell 50 contracts at at 50 cents, we will receive a premium of 2,500. If I do an XIRR, this is also one of our favorite in MoneyWiseSmart. We always look at the XIRR of the trade. The cash flow out would be 10,000 minus 2.5, which you receive. So your total outflow is 7,500 going out from your account. You are parking it out. It's not, you're not sending 7,500 to anybody, but we are investing it. We are leaving it in a pot in my account, safe. And if the option is not exercised against us, if the company does not go bankrupt, if the share do not fall below $2, we will receive our 10,000 back if it is not assigned in 2 years' time. The XIRR for this trade would be almost 15.5, 16%. And it gets more interesting that, assuming if the sanity returns to the market, the volatility starts going down again. And if we are able to buy this put within 1 year at, let's say, 5 cents, our cash flow out was 7.5, but we receive back within 1 year a cash flow in of 9,750. That will make the XIRR of this trade almost 30%. In this current low interest world, don't you think 15 to 30% is a very good trade? We think so. And so let's find out what happened. So we went into the trade. This was the situation on Monday. I mean, we were discussing it for a couple of days. We decided to short this 2-strike put at 50 cents at elevated walls. We placed our orders. And we were expecting the walls to keep going up. And an interesting phenomenon happened, that the stock is going up, but the put premiums were also going up. That comes a little bit as a counterintuitive to many people who would expect put prices to fall when the stock goes up. But if you are MoneyWiseSmart subscriber, you would know that's not always true. And this is the situation on Friday. As you can see, the walls have gone almost 80 points from where it was. Yeah, 60 points from where it was. And the premium has gone up, even though the stock has gone up tremendously within this period. The volume is big and the open interest has shot up, which means good part of it is our trade, but there are also similar-minded people who must be doing this trade. So we are not the only one. The premium surprise is entirely because of the rise in the vols. And the opposite will happen when the stock starts falling and the vols start falling. The premiums will also drop, which is another counterintuitive thing. That stock is falling, but the put is also going down. And when that happens, you will witness it. Luckily for us, we could get our full position into this trade. But immediately afterwards, the broker started putting restrictions and it was not able to open more position into this. I believe those restrictions are slowly getting lifted and some of them have already lifted it. So you will have to check with your broker. What are we doing now? We are just sitting tight on our position. We are fully in to our allocated size. And we are just watching the show. A lot of drama is going on. We are keeping a very close eye on the facts and the figures coming out from the market, not the opinions. We don't read the Wall Street bet, but we are watching the facts and figures coming out. And who knows, in future, there could be opportunities to adjust this trade, maybe take some call position and so on. Right now, everything is very expensive. We are not interested in buying the calls. We'll keep looking closely at this situation and we'll keep giving you further updates as and when it happens. So that brings me to the end of the video. Thank you very much all for watching it. Do subscribe to our channel and join our Facebook groups where we talk similar ideas and discussions in details. If you're interested in learning more about how to use options to generate cash flows and build long-term wealth, then do subscribe to our option series course. You can find the details in the description. We also look at potential multi-bagger opportunities using our deep fundamental research. And you can find that in our multi-bagger research series offering. We will keep you updated on the progress of this trade and if we make any adjustments and so on. So if you have liked this video, please hit like and subscribe, and you can get further updates on how we go about handling this trade or any other interesting subject. Do check out our research series. You will really find interesting business ideas there. Thank you very much for all your time and see you until next video. Until then, stay safe, stay healthy, and keep compounding for long term. Thank you.
Check out what happens in our monthly tutorial for our option series subscribers and what our subscribers say about us. Most of them gave us 5 out of 5 star rating, and one even gave us a 6-star rating. Join us for some very interesting and insightful discussions by all our members during our monthly tutorials.